Let's talk about the broken housing market. More importantly, what might fix the broken housing market, when that might come. We're also going to review a lot of earnings. We have entered earnings season. Of course, it starts with the big banks and then rolls into retailers and the like. We will talk about something Mohamed El-Arian had to say that I think is worth listening to. We'll talk about the Empire State Manufacturing Survey, which is our first economic report of the week. But you know what, folks? Let's start with active inventory. One of the things that I've been talking about for probably the last 9 to 10 months is we've been highlighting Mike Simonson from Altos Research, Lance Lambert from Resi Club, and Logan Montashami from Housing Wire. And all of these conversations each week were about the growing inventory, right? We've been seeing growing inventory. We've been seeing days on market climb. We've been talking about the bifurcated housing market. We've talked about disrespectful offers. But about a week ago, maybe 10 days ago, I let you know that it was my expectation that unfortunately, we were probably going to break the cycle low for transactions. The current cycle low, if you don't recall, was 3.88 million sales. I think sometime in the next, it could be this month, could be next month, we will unfortunately break that, and that will be the bottom. Well, what happened last week, 4th of July week, we had the lowest, the all-time lowest new listings for the week. Logan reported this on Sunday, I believe. Last week's new listings were 56,638. If you want to get a feel for just how low that is, in 2010, we had 379,771. So again, folks, what I've been telling you is I think the second half of 2024 is going to be slow. We are going to have to go through this, I don't know what to call it, depression level transactions to get to the other side. We're going to spend a lot of time today talking about the broken housing market and what might fix it. But yeah, again, this is just everyone pulling back, right? We not only have demand being pulled back, but now we're seeing, again, at least with 1 week, and again, we'll wait to validate this next week, an all-time low of new listings at 56,638. So again, it will be very interesting. Something we should be watching is mortgage rates. Mortgage rates last week ticked to 6.82. That is now obviously below 7%. One might argue significantly below 7%. Over the last 6 months or so, I've been highlighting 6.7% as an interesting number. Why? Because we haven't been below 6.7 in about a year and a half. And if I've learned anything about the consumer in 30 years of studying them, the consumer wants a deal. So as we get, or if we get below 6.7, and the farther we get from that on the downside, you should see marginal demand pick back up. However, if we head lower into the significantly slow period, the election, all of that, and just the consumers being scared, nervous, pissed off, whatever, there's going to be a lot of folks that just say, you know what, it's too hard, too risky, I am going to wait. And I think that's why the second half of 2024 is going to be particularly slow. One thing we should highlight is mortgage rates could get to 6% even, relatively in a straightforward manner. Now, again, I'm not one calling for the Fed to cut in September. More on that in a minute. However, there is this thing called the spread. The spread between the 10-year and the 30-year mortgage rate historically has been about 175 to 180 basis points. In this cycle, we peaked out at over 300. I think it is currently residing about 262 or 264 basis points. So what all that means is we have about 75 to 80 basis points that could be compressed away without a rate cut. And if you add on top of that a rate cut or two, we could see 6% mortgage rates sooner than more people or most people are expecting. But that will be very interesting. Let's talk about some earnings because, again, I want to close with talking about the broken housing market and what might fix it. We'll go to the big banks first. We had Goldman Sachs on Friday, beat top line, beat bottom line. Actually, Goldman Sachs was this morning, excuse me. Goldman Sachs was Monday, not Friday. Goldman Sachs beat top line, beat bottom line. They actually took a smaller loan loss reserves. I think one of the things you're going to see at the big banks and certainly at the regional banks, who should start reporting to, next week in greater numbers, is loan loss reserves. This is going to be important. How stretched, how broken is the consumer? But more importantly, for the commercial banks, how broken is their portfolio, right? How broken is their balance sheet? How much pain is coming? You're going to see that in something called loan loss reserves. Again, Goldman beat. JP Morgan beat top line, beat bottom line. Wells Fargo actually reported a disappointing number for net interest income and higher expenses. So again, Wells Fargo got whacked. Citigroup out with a bearish call. I don't know what else to call it, but certainly a bearish call. Citigroup is saying the Fed could cut 200 basis points. So what is that? That means 2 percentage points in the next 8 meetings. Citigroup thinks the economy is headed for a sharp downturn. Think about that, folks. The Fed today, what is it, 5.25 to 5.5? The next 8 meetings probably take us to June, maybe July of 2025. The Fed rate could be 3.25 to 3.5, which again, mortgage rates, let's just add 200 basis points to that, would put you certainly sub 6, probably at 5.5. However, we should be careful what we wish for. Be careful what we wish for. 200 basis point cut would mean the Fed is reacting to something very nasty. Certainly not a soft landing, probably a hard landing, maybe stagflation. I don't know. As I sit here today, that kind of reaction to the Fed or by the Fed, I don't know, doesn't seem plausible today. But again, I'm here sitting telling you that I think a recession started in June or July. But 200 basis points, that would be quite the cut or series of cuts. We got a couple of retailers out with disappointing and even pre-announcements. Burberry, obviously a very high-end retailer, issued a profit warning this morning. And I think we're going to see, again, I think the consumer is stretched. I think the stimmy money is gone. I think all of these stimulus ballers are broke. And they are going to not only not be shopping at Burberry and Gucci and, Prada and all of those. These folks likely are going to start to sell their stimulus balling toys on site. So again, something to watch. So Burberry, big disappointment. Swatch is the next one. Something I didn't know. I had no idea. Did you know this? Curious. Swatch is the world's biggest watchmaker. I had no idea that Swatch was the biggest watchmaker. But yes, Swatch is warning that profit is slumping because of very weak China demand. Folks, the Chinese economy is wrecked. It is not in a good place. It has been going on for 2 or 3 years. Obviously, the real estate catastrophe. We have the consumer pulling back, the consumer losing faith. It is all kinds of ugly and painful. So again, folks, China demand. If China demand for watches is down, you could expect that to be down in lots of other areas. How about Mohamed El-Erian, someone that I respect and follow? He is saying basically to the market, one bad data point could cause the Fed to postpone the first cut to November. Folks, I haven't checked this morning, but as of yesterday, the market was calling for a 96% chance of a September rate cut. I believe, and again, I am standing on a very, very, very small rock with 4% of the kind of experts out there. Yes, folks, one bad data point could cause the Fed to postpone to November. I think that's coming. I think Jerome Powell wants to go one extra meeting. I think he wants to break the Fed put. I don't think he wants to be yanked by the market. But the good news is We'll know at the end of July. Yes, folks, in a few short weeks, the Fed will meet. We will get their rate decision, which will be nothing. They will talk about a press release. And then, of course, we will get Jerome Powell in front of a microphone for 45 to 60 minutes. Will they set up a September rate cut, or will they continue to be slightly hawkish and push that to November? So again, we'll know very soon. But yes, I agree with Mohammed that I think the Fed is going to be seeking out that bad data point because they want to push the rate decision back as far as possible. So that is that. Last thing, the economic number before we talk about the broken housing market. Empire State Manufacturing. This is obviously a survey of manufacturers in the New York area. It came in slightly better than expected, but still negative. Last month was down -6. Expectations were down -8. Negative numbers means contraction, in case it is unclear. Came in at -6.6. So worse than last month, not as worse as expected is how you take that number. One thing to highlight in the survey is prices paid. Prices paid component took a big jump, which validates the high PPI reading from last week. Yeah, again, remember, folks, Friday's PPI reading was not good. It was a miss all across the board, and the Empire State Manufacturing Survey highlighted that again, highlighting that inflation might not be over. And again, back to Mohammed's point, could the Fed be seeking that validation or seeking bad data to delay a September rate decision? Again, we'll know at the end of July. All right, let's talk about the broken housing market. If you've been following this channel for a long time, you know that that's something I coined. Essentially, I've been telling you that the move-up buyer is stuck, is broken. And because the move-up buyer is broken, we are losing two transactions. The move-up buyer typically sells a home and buys a home. And because they are stuck, we are down and we might go lower than 3.88 million. So when we look at the housing market today, let's just review some numbers together. The 30-year mortgage rate today is 6.89% based on my search this morning. The cycle low occurred on January 7th, 2021, 2.65. I'm curious, anybody watching this have a mortgage rate below 2.65? If you do, you won. You're the winner. But yes, folks, cycle low is 2.65. Cycle high was 8.03. So again, you want to know when a 6.8% mortgage feels good? When you are used to 8%. And I would argue we've been used to 7% for quite a while. How about home prices? Home prices start January of 2020 at $210,000. This is according to Case-Shiller. They are now up to $320,000. Again, this is just showing the rapid rise in home prices. How about affordability? Affordability is a big deal. It's something that I used to sell all my houses in 2006. Affordability today is 93.1. The cycle low is actually October of 23, probably when mortgage rates are 8%. I did not validate that, but it would make sense. The cycle low, October 23rd, 91.4. Then the last thing we'll talk about, and then finally we'll talk about unlocking the market. Median income to buy the median home. What percentage? Today, 43.1. The peak or worse was 45.3. So we are slightly better than the worst. And of course, the cycle low was July of 2020, 27.5%. So what does all this mean? What does all this mean? Well, it means in the short term, folks, it's not going to get any better. Why? Because to fix the broken housing market, you need to do one of a few things. One, you need to unlock inventory. If you are sitting there, somebody watching this, and you are in a home and you have a 3% mortgage, and you are looking at mortgage rates at, let's just say 6%. Let's make up a number, 6.5. And you are looking at prices up 30%. There's a very good chance that you would not be approved for the move-up home, even if you bring all the equity from the new home. So in order to unlock inventory, in order to get the move-up buyer moving, one of the things that you have to do is you have to make that spread narrower. Now, the easiest way to do that is interest rates. You could take interest rates down, perhaps like Citigroup is saying, 200 basis points. But then you are in a recession. You have consumers scared. Will that be enough to unlock demand or supply? Maybe. If you got rates down to 5%, maybe they start to list and move homes. How about another crazy idea? How about you just make more homes? You build more homes. And to be clear, I am not talking McMansions. I am talking homes under 1,100 square feet. I believe Lennar is the first to move this direction, but there may be others. If the large builders took an orientation and said, you know what, we're going to go back to what was happening in the 50s to the 70s, where the entry-level homes were under 1,000 square feet, that could slowly, because again, it takes time to build homes, that could slowly create more first-time homes, and over time, it would be undoubtedly a fix for the housing market. How about more sellers? We need more sellers. Now, of course, more sellers could happen if we unlock the move-up buyer in example 1. The other one to have more sellers is we could have a repeat of 2008, 9, and 10. We could have a huge, gigantic foreclosure wave. We could have 10% unemployment. We could have everybody suddenly have to sell because of this, that, or the other. Now, I think that is always possible. There's no doubt that that is out there on the possibility scale. But I think we've learned something from history. We've learned something from the pandemic, that banks would bend over backwards to have moratoriums and extensions and things of that nature. We would undoubtedly have a Fed cut rates to 0 if unemployment spiked and stayed that high for long. But hey, if you are out there as a crash bro and you are hoping for a foreclosure wave, I will agree it is possible. The last thing I will say about a foreclosure wave is a foreclosure wave would not, absolutely cannot occur in 2024. You guys need to understand the timeline for foreclosures could be 700 days, 800 days, in some states 1,000 days, and that is without forbearance and all of these other things. So if you are out there telling your audience that foreclosure waves are coming, do yourself a favor. Talk about 2027, 2028, even maybe 2029. How about more buyers? More buyers. Again, more buyers as affordability got better, interest rates and or income increases, right? We could see true, real, and nominal income growth. That would obviously help the housing market with more demand. What does all of this mean? Unfortunately, the broken housing market will be broken for years to come. And by broken, I mean we will be below 5 million, 5.5 million existing home sales, probably for most of the decade. The answer to fixing the housing market, unfortunately, the most likely answer is time. Just time. We need years of wage increases. We need prices to stay flat. We need time to occur for more move-up buyers, right? Death, divorce, all of that. People that have to sell. It's not a fun thing to say that time is the best answer, but that is where I am at today. So, folks, the other thing to highlight today is Jerome Powell is speaking. That's always fun to talk about. Is he going to paint a picture of September? Is he going to remain data dependent? I think you and I both know he's not going to give up the goose today. But we will be paying attention. We will look at what he has to say. Alrighty, folks, have an amazing day. Like, subscribe, comment, become part of One Rental at a Time. Don't forget, in the school community, tomorrow you have the opportunity to interact with Henry Washington. Henry Washington will be in the school community. If you want to ask questions, do all of that. That will be there for you. Wednesday, if you haven't joined the accountability group led by Frank, Old Guy REI, you are missing out. That actually occurs in the evenings. I think the last session went 2 or 3 hours. So again, all are invited. If you want to be a part of school, it's $20 a month. Free education, great community, nearly 200 folks. Get in there now so you can learn, you can network, and you could be around other amazing folks. Have a wonderful day. Later.